G'day and welcome to the Global View on this Monday. I'm Andrew Gagan. Thanks for joining us here at AusBiz as we look ahead to the week. This follows what we saw on Friday with global markets down across the board. Stocks on Wall Street there closing sharply lower after President Trump said he plans to announce reciprocal tariffs on many countries this week. And in fact, he has just announced that he's planning to impose tariffs on steel and aluminium imports to the tune of 25% for those imports into the States. Now also the market reacting to a mixed payrolls report and weak consumer sentiment data. All three major indices there down for the week. The Dow breaking a 3-week streak of gains, ending 0.5% lower, along with the Nasdaq, and the S&P was off by about 0.25%. Stocks specifically, Amazon dipped on Friday due to weakness in the retailer's cloud computing unit and lower than expected forecasts for first quarter revenue and profit. Similar disappointments from Microsoft and Alphabet earlier in the week prompted concerns from investors that the mega cap tech stocks are losing momentum. And Uber shares accelerated after billionaire hedge fund manager Bill Ackman disclosed a large stake in the company. Well, expectations have risen that the US Fed will leave rates on hold in March after a mixed US employment report which showed job growth slowed more than expected in January, although the unemployment rate stayed at 4%. At the same time, wage growth strengthened last month, with average hourly earnings surging by the most in 5 months. Meanwhile, fears of higher prices from tariffs sent consumers' 12-month inflation expectations soaring to more than a 1-year high. Bond yields rose in response, with the 2-year up to 4.29%, while the 10-year rose to 4.5%. Markets are now pricing in a 55% chance that the Fed funds rate will be cut again by June. This as the US dollar has risen in response to the latest data and the threat of further tariffs from President Trump. And the Aussie has fallen back to 62.5 US cents. Bitcoin, well, it's trading around 96,000 US dollars. Checking commodities, oil prices rose on Friday after new sanctions were imposed on Iran's crude exports, but prices were down for the week as investors worried about a renewed trade war. Brent crude futures at $74 a barrel. Copper rose almost 3%. Iron ore up 1/3%, 107 US dollars a tonne, and gold climbing to $2,861 an ounce for its 6th consecutive week of gains, as escalating trade tensions prompt investors to seek refuge in the safe haven asset. So let's get across what we're seeing globally at the moment and how that's affecting markets. Isaac Poole is CIO of Ascalon Capital. He joins us now. Isaac, terrific to catch up with you again. Thanks for joining us. In fact, we just had news from Donald Trump that he is planning to slap 25% tariffs on steel and aluminium imports. I mean, markets, obviously, this adds to the uncertainty and the volatility we're seeing in markets.
It does. I think markets have really found it difficult to price in the risk of tariffs, especially with the sort of announcement and then the rollback. But we do think tariffs are coming more broadly. We've had the announcement just now. I think we'll see further announcements potentially reaching Europe this week. And that's going to be a difficult environment, I think, for risk assets to digest.
So let's then take a look at what other data, I guess, investors have to consider at the moment. I was mentioning some of that we saw out of the States on Friday, particularly those inflation expectations.
Yeah, I think the inflation story here is really important because we had the jobs report as well on Friday, which just suggested wage pressures are perhaps a little bit more pernicious than people had been expecting. They're sticking around. Inflationary pressures have been easing broadly over a few months, but they're just proving to be a bit sticky. And this week we'll get another read on inflation, which I think could also show that it's not getting back to the Fed's target as quick as they would like. And of course, that means that the Fed from here, it really has to stay on hold. They just don't have a really good reason or a really clear trigger for cutting at the moment.
Isaac, how are you seeing the US consumer travel at the moment? I guess wary that perhaps those prices will rise, particularly if we see widespread tariffs there. We do get a read actually on retail sales this week.
We do, and the consumer has been such a key reason for the resilience of the US economy. We have seen although there is some weakness in the lower income end of US households, the middle and upper end seem to be happy to keep on spending, even in the face of prices that are now very high compared to where they were a couple of years ago. And that can persist while the labour market remains strong. I think it can persist while animal spirits or consumer sentiment is solid. But we did get a read on consumer expectations for inflation and consumer sentiment on Friday. And expectations for higher inflation and sentiment was weaker. And I think that is a risk to the US economy looking forward. And while we have seen the unemployment rate sit around 4% or fall back to 4%, the number of jobs being added is slowing, and it's slowed again. And I think if that does continue, you could see a downshift in the rate of spending in the US. And that really would be a challenge for the US economy to re-accelerate through a slowing consumer.
Okay, so you talk about those risks to the US economy then. How does that translate, particularly I guess the risks to those high valuations we're seeing in the equity market at the moment?
Well, that's the big story. Valuations do look stretched. They're at historically high levels and growth is slowing. And that for me is an environment that really begs for more volatility. And we have seen that over the last couple of weeks. We've seen volatility around tariff uncertainty. We're seeing volatility as any earnings weakness or disappointment relative to what are very high expectations are just getting punished. And that is something that will probably persist. We have seen some broadening out of gains in the S&P 500, at least beyond the Magnificent Seven. But the challenge is going to be that we have so much priced in to those into that Magnificent Seven pricing that any disappointment could drag the index lower, and that can be self-feeding. So I think there is some real downside risk starting to build into the market at the moment.
Certainly there's been a focus on mega tech, given the reports we've had, and also in the wake, of course, DeepSeek and the ructions that caused in the market. How are you looking at that large end of the market?
I think that's it's at valuations that are uncomfortably high for us, and we've clearly seen a lot of money pouring into capex here. There's a lot of willingness to spend on tech and AI and potential productivity gains, but there doesn't seem to have been a massive pickup in demand amongst consumers, whether they're businesses or individuals. There doesn't seem to have been a real drive higher in return on investment yet. And therein lies the risk that we could see all this money spent, valuations get stretched, and then there's not a delivery in the near term to justify those valuations. And they will have to normalize one of two ways. Either earnings will reaccelerate, and we're not seeing evidence of that yet, or prices are going to have to come down to squeeze those multiples. And investors that have piled into that big end of town are facing some risk now, I think.
Isaac, beyond equities, how attractive are US Treasuries at the moment?
A little less than they were maybe a month ago when 10-year yields were 30 or so basis points higher. And we have just seen the volatility in what historically has been a defensive part of the market really stay elevated. But we do think that Treasury yields sitting up around 4.5%, if they back up towards 4.75% or so, that's attractive for us. We think that's pretty reasonable yield. And we still believe that there is downside protection from holding those treasuries. We still think it's going to give some real important ballast and resilience to portfolios, particularly if the US economy does slow. And that is a growing risk as we look through tariffs and we look through a consumer that might just be starting to get burnt out a little bit here.
And that uncertainty and volatility has certainly been reflected in commodities at the moment. Do you have a view there? I mean, particularly oil, given what's happening in that space?
Yeah, I mean, the oil price has also been volatile and trading, I think, off news flow as much as it is off fundamentals. And that could persist. And it itself is a challenge for the Fed and for US consumers because it operates like a drag on disposable income as prices go high and can contribute to inflation. Outside of oil, I think gold is very interesting at the moment because you are seeing, I think, a real strong safe haven flow into gold as people just look to park their money somewhere as they try and cope with the news flow and the policy flow on a day-to-day basis.
Meanwhile, gold rising, but also seeing that maintain that strength in the US dollar at the same time, essentially reflecting that exceptionalism we're seeing in the US. Is that under threat, though, do you think?
I think that that the US dollar, the strength there is a combination of a couple of things. One is the Fed looking to be on hold, which is a big divergence from other global central banks that are likely to cut sooner. There's also some safe haven flow there into the US dollar, but I mean it is elevated. Let's face it, the US dollar is very strong, and so further major gains will be hard, but I don't see a catalyst for any weakness in the near term. And that means currencies like the Aussie dollar, the Canadian dollar, they could come under further pressure in the near term. And it wouldn't be at all surprising to see the Aussie drop down below 60 cents in the next month or so.
Isaac, great to get a view of what you're seeing there on global markets. Thanks for joining us from Ascalon Capital.
Thanks, Andrew.
So that sets us up for the beginning of the week locally, and we are expecting a negative start there. As you can see, SPI futures off around 0.75%. Stay with us because we're going to get right across the open when we get underway in just a couple of minutes' time.